All right, guys, Walmart reported right before, actually this morning, it wasn't right before the opening. They crushed it. $1.50 in profit versus the $1.32 estimate, and $152.8 billion in revenue versus $147.5. Guys, welcome to the positive world of inflation. Walmart is going to be the kind of company that's going to benefit from inflation. Increased costs, it's easier to pass on those costs to people and maybe even put a little buffer in there for you. They beat on, and it takes a while for the expenses to come in on a lot of their things, so they crushed on that. They also announced a $20 billion share repurchase plan. If you're new to this channel, we have our 8 pillars, and one of the pillars is share buybacks. We want to see, are they keeping shares the same and buying them back, or are they increasing their shares? Now, one thing, just because it's one of our pillars does not mean that buying back shares is a good thing. Mo, can you explain to the people why that is?
Because if you're buying shares back at a very expensive price, you're doing no service to you as a company or your shareholders.
Especially the shareholders. You're taking the shareholders' capital and investing it into an expensive company. Yes, it's your own, right, but it's still expensive. And a lot of companies use the share repurchase as a way of manipulating EPS, driving up EPS. And they're thinking, I'd rather have a company that has expensive shares, give it out in dividends. Give that cash out in dividends. Now, I don't know where Walmart is. I haven't looked at Walmart in a long time.
Yeah, it's been a very long time.
So I don't know the valuation. And by the end of this video, we're going to use our stock analyzer tool, which is the most important, which is one of the most famous part of our software here, the most used part of our software, to figure out what price to pay for Walmart, not factoring in the balance sheet. So let's take a look at Walmart. Let's type it in here, WMT.
Something interesting about Walmart, when you go to the income statement.
Holy cow.
Yeah.
7.5%?
Yeah.
All right, let's go to the income statement.
And I just scrolled right to the bottom. So since 2013, I'm just looking at the last 10 years, they've been buying back shares every single year.
500 million shares less than 2013.
And I could go back to 2012 and see. Let's see here.
Let's see what that looks like, Mo.
Yeah, they've been buying back shares for the past 20 years.
So remember, when you buy back shares, you're still spending money on an investment. It's just investing in your own company. That doesn't make it good or bad in and of itself. What makes it good or bad is the valuation that you're buying back at. Okay, so let's look at our 8 pillars here. Boom. All right, Mosafine, check this out. We got a high PE and a high price of free cash flow. Yeah. So off the dribble, I'm like...
And there's a discrepancy between the two.
And there's a sizable discrepancy.
Yeah, big one.
Sizable discrepancy. Now, the one thing I'll say is they are reporting higher free cash flow than earnings, because when the price of free cash flow is lower than the earnings, it means this has a higher amount of free cash flow. So I'm excited that it's this way, not the other way. But free cash flow growth has actually decreased.
Yeah.
How is that possible? That's weird.
So I'm at the cash flow statement.
What's going on there?
So they were doing, I'm going to call it mid to high teens of cash flow, 16 billion, 17 billion, went to basically 23.5 billion, and now it's 5.5 billion.
Oh, okay. So it's a one-time anomaly. It's not just like it's...
Yeah, so just like this was a one-time anomaly, this is probably a one-time anomaly. I expect them to get back to the 16, 17, 18 range.
All right, and that's how you use long-term averages. Yeah. So let's look at our main metrics page first. Market cap of 405. One thing that's interesting to me is this is a company with, 11,000, 12,000 locations around the world. They don't own those locations. They release them. But look at their enterprise value. I'm actually surprised it's so low. Even though it's still, enterprise value versus market cap is basically your debt difference. I would have thought a lot more debt for a company with this many locations that are so large with capital leases in place, right? All right, dividend yield. Forward dividend yield of 1.7%. It's going to pay out, let's call it $6.5, $7 billion. They can afford that based on their 5-year free cash flow. Yes, their last 12 months can't afford it, but I think it's a temporary thing. Yeah. It's a change in working capital. 5-year return on invested capital, solid. Profit margin, guys, this is about the profit margin. Look at this, 24.6. You know, we did a video on Amazon yesterday. We recorded it yesterday. I don't know when it's coming out. It's probably going to come out sometime in the future here. So the interesting part is their gross margin at Walmart is 24.6. This means for every extra dollar they sell, 24.6 cents goes to their profit before overhead. Amazon, with AWS, which is a very, very high margin business, they were only at like 12.9%. So here's Walmart, bricks and mortar, tons of locations, tons of employees. What do they have? Like 3 million employees? I mean, something crazy like that. And their gross margin is still double what Amazon's is. And look at their profit margin. This is a very low profit margin business. For those of you out there who sit there and complain that all these Walmarts of the world are so, guys, it's 2.4%. That means every dollar they make, about 2.4 cents of it goes to the bottom line after taxes. That's crazy.
Yeah.
All right, let's see what analysts are saying.
2.3 million employees.
2.3 million employees. All right, here are analyst estimates. This is what our data feed pulls in. So for the next 5 years, they have reasonable growth, nothing crazy high. All right, so it's about a $2.30, so call it 40% increase, 35% increase over the next 4 or 5 years. Guys, it's not a sexy business. It's not going to grow a ton. It's not sexy. Revenue-wise, look at this, low single digits. Makes sense. It's a huge company. So going back to the buybacks, is the $20 billion in buybacks, which is about 5% of their outstanding market cap, is that really a good decision? Well, let's go to the stock analyzer tool and decide what we're going to pay for the company based on that. If the stock is currently at 148, if the stock price that we want to pay is much lower, I'm very upset that they're buying back shares. If it's about this or higher, I can understand it. Because what we want is, if the company hypothetically was selling for 5 times earnings, boy, yeah, buy those shares back. Buy those back. You're paying a big dividend, all these things, like save that money. But something tells me that's not going to be the case based on our 8 pillars.
When I look at a 30 PE, I'm going to say, ooh.
Yeah, 30 PE. I'm going to ignore this price of free cash flow because of the anomaly over the last year. But it's basically about a 30 price of free cash flow. So Mo, low, middle, and high on our revenue growth numbers, because we're going to do a 10-year analysis.
Okay.
And we're going to sit there and understand where we are.
So I'm going to say -2, 0, and 2. However, I think -2 is low.
-2 is insane, Mo.
But on my high side, I have to go 2.
See, I disagree. We have inflation coming. We have inflation here.
But that's not.
That's going to drive
around for a decade.
No, but it's going to drive the next few years. Mo, I think -2 is insane. I wouldn't even put it in there. Because I don't think that's even a reasonable.
Analysts are at 3 for 5 years.
Yeah.
So
I honestly, I believe to myself like 1, 3, and 5.
Oh, okay.
And the reason being is, if we have steady inflation for 2 or 3 more years, that'll really drive up revenue. They're opening location. I think -2 is unfair.
-2 is too low, but 2 on the high side.
So why don't we do this?
I wouldn't go higher than 2 on the high.
Okay. Why don't we do 0, 2, 4? And here's the reason why.
Okay.
I do think, look at it this way. For a mature company like Walmart, I think following the nominal GDP growth is a reasonable number on the high, for a minimum idea. Like, I even think 0%. I don't think I should. I'm going to disagree. I'm going to go 2, 3, 4.
Okay. I'm going to pay attention to this low end then.
Because I really do believe that 0% is even an egregious. I'd be very shocked if I woke up 10 years from now and Walmart's revenue is exactly the same as it is today. I would be absolutely floored.
Okay. I wouldn't.
You wouldn't?
No.
You wouldn't.
I just don't think.
Look at how much they increased their revenue in the last year, in the last quarter, just from inflation numbers.
Right, but I mean, where do they have to go?
Do you think we're going to be in a deflationary environment here in the next decade?
Deflationary?
Yeah.
Probably.
No, we're not.
You don't think in over 10 years?
Deflationary.
Yeah.
When was the last time we had deflationary over 10 years?
I'm not saying that it's going to last 10 years.
It doesn't matter. But the deflationary environment for the next 10 years, that means you think from now until 10 years from now, prices are going to go down.
But even if there's a deflationary environment in, say, 5 years, 6 years.
I'm talking about for the next 10 years. You think costs will be less or more than they are today?
More.
Okay, that's not a deflationary environment. That's an inflationary environment.
Well, I don't think that.
And when was the last time we had a 10-year period?
Also, I don't think that costs are going to level off at some point, I think.
Yeah, but even leveling off means 2 or 3% inflation.
Yeah.
That's what I mean. Like, even your leveling off is still 2 to 3%. That's why I don't think you can put in the low number at -2. So even with any inflation of 2 or 3% is going to help Walmart.
So
any inflation. Yeah.
Let's say they raise prices on X product, doesn't matter what it is, because of inflationary environment. Do you think they bring it back down at all?
No.
Okay.
Now, if we have deflation overall, yeah, they'll have to, but I don't see deflation being an issue here. And even deflation is worse than inflation. You better believe if there were deflationary concerns out there, the Fed would cut rates like crazy. Because deflation, the reason it's worse than inflation is people will postpone purchases saying, well, I don't need to buy this. I'll just wait till the very last second I need to buy it, because the longer I wait, the lower the price will be.
You don't think we're going to get into an environment like that?
In a long period of time?
Mm-hmm.
No, absolutely not. Why? What would indicate that that's the case? By the way, if you believe the world's going to print more money...
Let me ask you this question.
Well, hang on a second. If you believe the government's going to print more money, that goes against deflationary environment.
That's a good point when you talk about the government.
Yeah.
I lost my train of thought.
Sorry. The whole point is, this is why I'm glad we're having...
It was a good question. I can't remember what it was.
Obviously, it wasn't that good.
It was really good. You just botched it.
So the great news about this conversation is, this is literally Mo and I we have not talked about Walmart at all today.
Or, God, in the last 6 months.
Yes. And now we're sitting here, and I literally looked at him going, -2? Are you out of your freaking mind? No way. You're telling me that Walmart will have... The -2 means Walmart will have 18% less revenue in 10 years than it is today.
If I were to do this analysis on my own, not for the video, I probably would have, instead of having a low, middle, and high, I probably just had a one category, because I would have put in 2.
All right.
That's
By the way, you can always do 2, 2, 2, and then alter your profit margin.
I'm going to pay attention to the low end.
Profit margin. Let me guess, -4.
-6, -12, and -18.
All right.
2, 2.5, and 3.
Okay. Free cash flow.
Same for free cash flow.
Okay.
Although it is a little bit higher.
PE.
12, 14, 16.
So I actually agree with Mo to a certain level on this one. This is a very low growth company. It has a very big moat though. So it kind of competes on the 12. Like, I would be okay with to me, when I look at this low number, I'm going to think this is like if it hits this, it's probably because we're at secular lows in the stock market. Like, I think this is a really low. So, all right, desired return, Mo. Remember, desired return, guys, is basically your margin of safety, because you can get 9 or 10% over long periods of time by investing in a long-term ETF. So over here, as you get higher in your assumptions, your desired return should be higher because it's less likely to occur. So Mo, tell me 84%, 120%, and 2 billion %.
13. 15. 17.
Oh my God.
What would you put in?
I'm vetoing. 12, 13, 14.
All right.
Mo, 17%? 4 is not high.
All right. Well, I guess we'll see in a decade.
Yeah, we will see in a decade. Hit the analyze button. Why is 4 high? I want to have this conversation. Why is 4 high?
I mean, how are they supposed to? I just don't understand how much more this company.
Let me ask you this question.
People go there. They have a very loyal following.
Let me ask you this question. If inflation was 2.5% for the next 10 years, would that be egregious or about right?
Oh, right.
Okay. So will Walmart increase its cost with inflation or without inflation?
With.
Okay, so that's 2.5%. What about opening more locations? As the world expands and gets more economically, can they drive another percent? Is it egregious to think they can drive another 1.5% a year in revenue growth from opening more locations? We just got there in a matter of 2 seconds. Just by me saying, hey, open more locations.
All right. So,
and I'm not even talking about it being a normal situation.
When you look at the analyst expectations, they're at 3% revenue growth for 5 years.
I don't think it's going to be much different. I think Walmart is in a perpetual growth pattern that should like you said, you might be right on. I still think 2 is low, and I don't think 4 is that high. That's why I can't go. It's not like I sit there and say 4 going, how the F are they going to get 4? Now, to me, if you want to go high, the 6 number might be 6 because, hey, what if we have inflation for a really long time? What if it's higher than we think for a while? Okay, but 4 to me, I'm like, well, if we get to 2.5%, 3% inflation again, which is about history, history is 3 to 3.5%. If they open 10% more stores, we're there.
All right. Let's see what the numbers are.
It's going to be bad either way. Hit the analyze button. Now, guys, remember, we're going to get 6 numbers, a low, middle, and high on earnings estimates and a low, middle, and high on free cash flow. If they're all green, it doesn't mean go out and buy. It means go do your research. Easy way to do research is join the community at everythingmoney.com and sit there and have conversations with the thousands of investors in there who are like-minded. All right, analyze button. Yeah, here we go. 46. High of 81, middle price of 63. Okay. That's where I look at this thinking myself, okay.
So what would you pay for this? Where would you start selling puts?
You put free cash flow margin at...
I just want to get on my watch list.
Oh, so I'm going to put it on my watch list probably at $80 to start selling puts below that. And I look at this saying Walmart should not be buying back shares. Because let's assume the rosiest of rosy assumptions. 6% revenue growth, 3.5% margin, which hasn't happened, 16 PE, and let's say they're worth 10%. The high end, well, I guess it's there if you make the highest of rosiest assumptions. I just don't think that's where we should be. Now, am I being more conservative at 80? Probably. It probably is higher than 80. How much higher? I don't know, but it's probably higher than 80. But I'm going to be conservative because my goal is different than yours. So remember this, you go forward, that this is all the art of investing. Mo and I, who are like-minded people, just had an argument on air for 5 minutes about our assumptions because Mo thinks that Walmart should decrease its revenue by 20% over the next 10 years.
I am actually going to put in 70 for my watch list price.
Okay.
Because their options suck.
Okay.
So to get a good premium, I need to have a lower price.
Good boy.
Thank you.
Thanks very much for watching the channel. Please subscribe and check out everythingmoney.com. Take care.